Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. On today's show, we're talking about the current macroeconomic climate and providing a forecast for interest rates for the second half of this year. Fact is, we live in an interconnected world, and the attempts by central bankers to look at the economy within a nation as a closed system is extremely naive. We have Germany, and now most of Europe, in recession, having experienced 2 consecutive quarters of economic contraction. New Zealand is now officially in recession. Europe announced last week that it was increasing its benchmark interest rate by a quarter point at the same time as the U.S. paused its interest rate hike. The interest rate on the main refinancing operations and the interest rates in the marginal lending facility were increased to 4%, 4.25%, and the interest rates for the deposit facility to 3.5%. These rates are considerably lower than the corresponding rates in the United States, where the federal funds rate sits at 5 to 5.25%. The Bank of Canada also increased its benchmark rate by a quarter point a little over a week ago. The overnight rate is now 4%, the deposit rate 4.75. These two are also below the corresponding U.S. rates. In each of the announcements, none of the central bankers made reference to any economic weakness. The rhetoric was focused on fighting inflation, which remains elevated in Europe, the United States, and Canada. The biggest news in the past week is that China announced a drop in interest rates and is launching a massive public infrastructure spending program aimed at stimulating its flagging economy. As the largest manufacturing economy in the world, China's manufacturing is a bellwether for global consumption. The promised economic jolt from China's reopening from the COVID-19 lockdowns failed to materialize. It was an economic whimper. The best forecast for the economy can be found in the oil sector. Oil futures for August delivery are now at a 12-month low despite 3 consecutive announcements from OPEC Plus that they will cut production. Oil consumption usually peaks in the summer months as people are taking summer holidays and they drive further distances. We should be seeing higher oil prices right now, and we're not. We know there's one inescapable truth. For every unit of economic output, there's an equivalent unit of energy consumed somewhere in the world. The fact that global energy consumption is down is the clearest indication of economic slowdown. Energy consumption is not a metric that is prone to government manipulation. It's not seasonally adjusted. You either see inventories building or falling. You see surplus or shortages in the supply chain and in the spot market. Now you might be wondering if the transition to electric vehicles is partly a factor in the fall in oil consumption. Well, in the past 12 months, electric vehicles accounted for about 10% of new vehicle sales in the United States. The overall penetration of electric vehicles in the U.S., though, is about 1% of the vehicles on the road. But we don't know what percentage of the miles driven that represents. Given the shorter range of electric vehicles and the longer refueling time, we might estimate that the actual number of miles driven by electric vehicles represents less than 1% of the total miles driven. So on that basis, I'm going to assert that electric vehicles are not having a significant impact in oil consumption. For that reason, oil consumption is still a very useful metric in determining what's happening in the economy. In fact, as developing nations transition to higher GDP, the number of people driving gas-powered vehicles is actually increasing in absolute terms. So we should see energy demand rising, and we're not. That means that the global economy is shrinking faster than we even know. The energy markets are telling us very clearly that the global economy is slowing. Now, Jerome Powell, in his remarks and press conference last week, was hammering home the message that we should expect 2 additional rate increases between now and the end of the year. The fight against inflation isn't over. But if I'm to believe the narrative, then why didn't they raise rates again? The words and the actions, and more importantly, the economic metrics don't match. I believe this is the last Fed hike for the foreseeable future. In fact, the strong employment numbers that seem to point to economic strength are not supported by the hours work metrics. Employers will cut hours before they cut staff, and there's clear evidence that they're cutting hours. The inflation metrics will reduce in the U.S. simply by virtue of how the metric is constructed with a time delay. But more importantly, the world has entered into a recession, and we'll see elected governments the world over pivot to stimulate economic growth, even if the stimulus has an inflationary risk. Governments and central bankers are often working at odds to each other. Central bankers have a flaw in their model. They assume that raising interest rates will lower inflation, but that's not necessarily how it works. Our current bout of inflation was the result of a supply shock, combined with monetary stimulus that hit consumers' bank accounts at the same time. Too much money chasing too few products. Of course prices were going to go up, but we no longer have those market conditions. Those stimulus checks have disappeared, and we no longer have a supply chain shock. Central bankers seem more worried about a 1970-style surge in inflation than they are about a 2008-style collapse of the financial system. And despite the rhetoric, I remain convinced that government spending is going to rise, deficits will rise, and that economic stimulus is just around the corner. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.